Interest rates in Canada are now sitting at 2.25%. And that shift is going to change how people buy, sell, and invest in the GTA. This is not about headlines, it's about what this means for your next move. If you think lower rates automatically mean cheaper homes, we're about to see why this is not how it works. Hi, I'm Marco Momeni with 24 years experience in Toronto's real estate. Me and my team at Remax Hallmark are number one team in Ontario by volume. Here, we look at politics and policies, market shifts, and world events and local events that's shaping the GTA's housing market, and how to make smart decisions in the middle of it all. The Bank of Canada overnight rate is now sitting at 2.25%, down significantly from the peak level we saw not long ago. This isn't about celebration, it's about relief and economic stabilization. Because let's be honest, for many Canadians, it already feels like a recession. Groceries cost more, rents and mortgage costs are heavy, line of credit payments have climbed, and savings are getting drained just to keep up. This is not about the boom cycle, this is pressure management. And here's the core issue: the Canadian economy has been stalling. We saw GDP shrinks by about 1.5% earlier this year. And the real driver wasn't inflation, it was a trade shock. Our exports, especially to the US, fell by roughly about 27%. That decline led to job losses and reduced hours in trade sensitive sectors across Ontario. So the Bank of Canada made a calculation: prevent a deeper slowdown now, even if that means accepting some currency pressure and temporary inflation risk. This is a stabilization, not a stimulus. The US Federal Reserve has now cut rates for the second straight time, bringing the US interest rates to the lowest level in 3 years. Meanwhile, the European Central Bank is expected to hold rates for about 2% for some time, probably for a couple of years. Because the US is also cutting, the pressure on the Canadian dollar is reduced. That gives the Bank of Canada some more flexibility to support households without triggering a currency shock. But Canada's motive remains different. Our household debt levels are higher, much higher, in fact. Our economy is more sensitive to trade slowdowns. Affordability pressure is tighter. So while the headlines look simple, the strategy behind this is anything but. And here's where this becomes real. Fixed mortgage rates are now sitting about 3.8% to 4%, down from around 6.5% at their peak. On a $500,000 mortgage, that's about $800 or so savings a month. This supports homeowners under renewal pressure. It helps first time home buyers entering the market and improves investors' cash flow. And it helps prevent forced selling, which keeps the market more stable and not crashing. Every rate cut solves one problem but creates new risks and more challenges. One of the challenges is that if you rely on GICs and if you have a saving account, your incomes will be considerably lower now. And the other risk is the lower borrowing costs can pull buyers back faster than sellers return. With limited supply in the GTA, that can push the prices higher again. The other risk is even though the US has also cut the rates, their policy rate level remains higher than Canada's. That policy gap can pressure the Canadian dollar. If the loonie falls below the 70-cent level, the cost of importing groceries, fuel, construction materials rises, bringing inflation back through the currency channel. So lower rates don't automatically make homes cheaper. They change competition and they change the cost structure of daily life. And this is where most buyers and sellers make the wrong move because they are reacting instead of planning. If you are a buyer, run your affordability using today's rate plus 1 to 1.5%. If you're still comfortable, that's a sound decision, not a gamble. If you're a homeowner, This may be a good moment to restructure or lock into stabilized payments. If you're selling, rate cuts increase buyers' activity before sellers return. Listing now often means less competition. If you're an investor, only proceed if the property cash flows today, not based on future hopes. Rates may shift, but a strategy is what protects your equity. If you are considering a move in the next 1 to 12 months, let's talk. A short conversation now could save you thousands of dollars later.